This morning, a line I've tracked for over a decade didn't just get tested, it got printed. $100, $12 per ounce at 11:10 a.m. Eastern, January 23rd, 2026. And while the usual coverage repeats volatility like a metronome, the bigger story sits underneath the ticker. Before we go deeper, hit like, subscribe, and turn on notifications. In the next few minutes, you'll see why the screen price is starting to separate from the real-world price of metal you can actually source. Because this move doesn't smell like excitement, it smells like availability. It looks less like a normal rally and more like a pricing system running into a physical limit. I don't only watch charts, I watch delivery notices, vault classifications, freight routes, refinery throughput, and premiums, those quiet numbers that answer one brutal question. Can you get the metal? Right now, that answer is getting louder. Start with a data point nobody can spin. Shanghai versus New York. Silver around $111.67 on the Shanghai market, while New York spot sits near $100.12. That's an $11.55 gap, about an 11% premium. And it hasn't been closing the way functional arbitrage normally behaves. In calm markets, spreads like that get squeezed down fast. Big desks buy the cheap market, sell the rich market, and the gap disappears. So if the gap stays wide, it's telling you the trade isn't just click and profit. The trade is find bars, secure title, arrange delivery, move them, and survive the delays. And delays in physical markets usually mean one thing. The metal isn't sitting there waiting. It's already committed, already spoken for, or already gone. Picture two stores selling the same product. Store A offers it for $100. Store B pays $111. Store A gets cleared out until either Store A raises the price or Store A runs out of inventory. That's the West and the East right now. New York and London are Store A, Shanghai is Store B, and the shelves being emptied are Western vaults. This is where a concept most people ignore becomes the center of the story: backwardation. Normally, future delivery costs more than spot because you pay carrying costs, storage, insurance, financing. That's contango. But in a shortage, trust in future availability drops, and now delivery becomes the premium product. Add a persistent premium in Asia on top of that, and you create a gravity well. If paper in the West prices cheaper while physical in the East pays up, every free ounce gets pulled toward the higher bid. That pull doesn't care about headlines. It cares about inventory, logistics, and time. And if you think round numbers matter more than plumbing, zoom out for a second. Milestones like 100 become psychological headlines and attract new eyes, fast. But the physical market doesn't care about round numbers. It cares about settlement, availability, and whether the next shipment can be secured. Now look at a second signal, the gold to silver ratio. With gold around $4,966.46 and silver near $100, 12, the ratio is about 49.6 to 1. For long stretches, it lived closer to 70 to 90. A drop toward 50 doesn't whisper normal. It shouts repricing pressure in silver specifically. And when silver reprices, paper structures get stress tested. Because paper markets survive on a quiet assumption, most people don't demand the thing. They trade exposure, roll contracts, offset positions, and settle cash to cash. That's how a futures market can represent far more silver than exists in deliverable bars. But when spreads stay big, exposure turns into a simple demand. Deliver it. That's when delivery notices become the heartbeat. Here's a detail that separates real signals from comforting headlines. Total inventory is not the same as available inventory. You'll hear numbers like 150 million ounces in vaults, but the key word is registered. Metal actually positioned for delivery. Eligible metal can sit in a vault and still not be offered for delivery because the owner isn't selling it into the system. So when registered stocks trend down, the exchange faces a choice it hates: let price rise hard and punish the short side, or keep price restrained and watch physical outflows accelerate. There's no comfortable middle when the incentive to pull metal elsewhere stays alive. And why does that incentive stay alive? Because moving physical isn't instant. Bars need to be located, verified, sometimes reassayed, sometimes recast, then insured, shipped, and received. If the premium is still there after costs and time, it means the demand on the receiving end is serious. Here's where it gets even more revealing. Physical form matters. A price can be quoted for futures, for unallocated accounts, for shares, for promises. But industrial buyers and serious holders need bars with serials and settlement terms. When demand concentrates on deliverable bars, premiums show up in places that headlines ignore: longer lead times, higher fabrication premiums, and allocation requirements that weren't there last year. This is why the spread isn't a simple trade to close in minutes. Shipping is expensive. Insurance is expensive. Refineries have throughput limits. Customs can add delays. Working capital is tied up while metal is in transit. Yet the gap persists anyway. which implies the premium is large enough and the urgency strong enough to overcome real friction. Now connect this back to what you can observe without being on a trading desk. Call any large dealer and ask 2 questions. What's the premium? And what's the lead time? Those answers often move before the headline does. When lead times extend and premiums widen, that's the physical market voting with its feet, even if the screen price looks calm for a day. And once that happens, the screen price starts acting like a suggestion. Spot becomes a reference number, not an offer. The true price becomes what it costs to acquire in size with delivery. That's what it means when a pricing mechanism loses control. The market stops believing the posted number reflects reality. This is also why the chart says bubble is an incomplete diagnosis. A chart can't show you a loading dock. A candle can't show you a vault door. When the market is stressed, logistics is the real chart. So expect the media response to focus on volatility and protecting retail. You'll hear warnings about speculation, emotional stories about people getting hurt, and confident predictions of a crash. What you won't see as often is the premium data, the delivery intensity, and the registered inventory trend. If you want to track what matters, stop staring only at the 1-minute candles. Watch the Asia premium. Watch how often delivery demand spikes. Watch whether registered supply keeps thinning. As long as that spread remains wide, metal keeps moving, and the paper price becomes less representative of the real acquisition price. Now we have to talk about who sits on the other side when silver reprices this fast, concentrated short exposure. For years, a handful of bullion banks and large dealers have carried significant short positioning across futures, options, swaps, and off-exchange structures. The exposure is layered and netted so the public can't see a perfect number, but stress shows up when the market demands physical settlement. Here's the core issue. You can't source your way out of a shortage with accounting. If counterparties insist on delivery, the question becomes, where are the bars and who holds clean title that isn't pledged elsewhere? Cash settlement reduces pain only if everyone accepts it. And stress regimes are when people stop accepting promises. That's why liability math matters. At $100 per ounce, every large short structure becomes far more expensive to maintain, hedge, and roll. And if physical settlement pressure rises, the exposure stops being theoretical and becomes a procurement problem: metal, quantity, location, timing. Now compare that to what's actually deliverable. Vault totals can look big on paper, but the deliverable slice is always smaller, and it gets smaller fast when owners decide not to lease or sell. In a stress event, there is silver somewhere is not the same as there is silver available to you today at the posted price. You can see this stress leak into paper proxies. When products designed to track spot show unusual gaps versus the real cost to source bars, the market is pricing counterparty risk. It's not a moral judgment. It's how markets behave when settlement certainty gets questioned. Now, the skeptic's favorite line: this is vertical, so it must be a bubble. Yes, silver moving from the 30s to the hundreds in a year is extreme, and parabolic moves can reverse hard. But scarce physical commodities in shortage can move violently because the old price was a paper reflection, not a physical clearing price. The higher price brings supply argument gets overused too. A large share of global silver output is byproduct supply from copper, lead, and zinc mining, so output doesn't ramp instantly with the silver chart. New primary projects require years: exploration permits, capital construction, and ramp up, so supply response is slow by design. Meanwhile, industrial demand doesn't politely pause. Silver is embedded in electronics, specialized components, solar, and manufacturing lines where substitution takes time and re-engineering costs money. When availability tightens, industrial users behave like operators facing shutdown risk. They lock contracts, hoard, and pay premiums to keep lines running. So what happens next depends less on chart patterns and more on how exchanges and regulators respond under stress. Margin hikes are the classic lever: raise required cash, squeeze leverage, force liquidations, and trigger violent down days. Those down days can look like the story is over, even while the physical pressure remains. This is also why the outcome space narrows as the spread persists. Either Western prices rise enough to close the premium and slow the outflow, or physical availability tightens until the posted price is ignored. When that happens, volatility isn't the cause of the story. It's the symptom of a market trying to reprice under constraint. But margin hikes don't create silver. They only decide who's allowed to hold paper exposure, and they can shift pain from one group to another. If the spread remains wide, the metal still has a reason to move. The bigger lever is settlement language. If you ever see official notices leaning on emergency clauses, cash substitution, delayed delivery, alternative settlement, that's not a footnote. That is a public admission of stress, and it changes how people value claims versus metal. And that brings us to the uncomfortable part. If you built a system on paper calm, stress forces you to choose who gets protected. Exchanges protect themselves first. Then they protect clearing members. Then they protect liquidity providers. Everyone else adjusts to new rules. That's why sudden margin changes, trading halts, position limits, and settlement tweaks tend to appear in the same chapters of market history. So if you're watching this as a spectator, don't just watch price, watch policy. A single rule notice can change behavior more than a $5 move, because it changes what owning silver actually means in that market. And if you're using leverage, understand one harsh reality. You can be right on the thesis and still be forced out by margin mechanics. If you hear a sudden pivot to this is irrational while premiums remain elevated, treat that as noise management. In commodity stress events, the narrative often lags the plumbing. The plumbing is where the truth shows up first. One more layer, narratives. When a market becomes politically sensitive, the public story often shifts to reckless speculators and protecting the little guy. But the private game is about managing systemic exposure, keeping settlement orderly, and preventing a confidence spiral in the plumbing. That's why the cleanest signal stays the same. Physical premium and delivery strain, not commentary and charts. Keep your focus on spreads, stocks, and official notices, the measurable stuff. Now here's a clean dashboard to watch. Education, not financial advice. I'm not your advisor, I don't know your obligations, and I can't size risk for you, so treat this as a framework for reading the tape. Number 1, the Asia premium. If the premium stays meaningfully wide, the incentive to pull metal east remains. If it compresses and stays compressed, pressure eases, and the regime can shift. Number 2, registered inventory trend. Ignore headlines and track what's actually available for delivery. Total vault numbers can mislead. Availability is the key. Number 3, delivery intensity. Watch whether more contracts stand for delivery instead of rolling. That's the stress test that reveals whether the paper system can perform. Number 4, margin policy and rule notices. A margin hike can trigger a liquidation dip without solving the shortage. Any hint of alternative settlement changes how paper claims trade versus physical. Number 5, price versus acquisition cost. Spot is a reference. The real question is, at what price can you source metal in size with reliable delivery terms? If you want the deeper background, how concentrated positioning formed, why the structure was fragile, and why physical premiums lead the story, watch my previous breakdown after this video. And if this helped you see past the headlines, hit like, subscribe, and share it with someone who still thinks this is just another meme narrative. When price discovery shifts from paper promises to physical constraints, the data leads and the news cycle follows.